Good day to you. We will be having a interpretation and analysis of financial data today as a topic. Welcome to YouTube channel of Accounts and Business with Made Easy with Abiola. So why ratios? When business makes a profit, you may automatically think the business has had a good year. So you need ratio to confirm. High profits don't necessarily mean the business has had a good year, as you need to consider other factors. There are two key areas: profitability and liquidity. Users of this information include shareholders, employees, pressure groups, suppliers, customers, tax authorities, teachers, researchers, competitors, and a whole lot of others that use this financial information. So what does it user want? Managers as an aid to make general decision and to make decisions regarding planning and control. Employees, existing shareholders, potential shareholders, general public, government agencies, financial press. Please, you may pause this video now and read through all the users and why they need the financial information and what they need it for. The method of arranging data for analysis purpose. You can use horizontal analysis, you can use trend analysis, you can use vertical analysis and ratio analysis. Horizontal analysis from raw horizontal, we use similar information over time. Trend analysis, we use different years information. Vertical analysis, top down, and ratio analysis, which is the main thing that we are doing here today. Performance evaluation. Please, if you are studying this topic for exam purpose, question on interpretation and analysis generally require performance evaluation using ratio analysis. Learn the following ratio formula and what they reveal. So performance evaluation includes what do users ask? Is the business performing better or worse than last year? Is the business performing better or worse than similar businesses? And is the business better or worse than the figures available for publicly quoted companies in the same business sector? So the types of ratios that we have are profitability, liquidity, efficiency, and investment ratios. We also have gearing ratio as the fifth one. This is an example of a financial statement of Oyan Megenta PLC. You can pause this video now to study the income statement and the balance sheet. They will be used for the ratio analysis. For profitability ratios, the common ratios that we'll be looking, the common assessment we'll be doing here are ROCE, return on capital employed, gross profit margin, markup, profit margin, gross margin markup, and expense to revenue ratio. Return on capital employed is profit for the year before interest and tax over capital employed times 100. Look at this information again. Profit from operation for 2015 is 500, for 2014 is 460. That is profit from operations before uh, before interest and tax. So capital employed is your capital or equity plus non-current liabilities or debentures. So multiply that by 100. So the answer for 2015 is 15. 2014 was 19.21%, 15.21%. That means there is a decline in the ratio in in this returns on capital employed. So it behoves the management to look at some of the things that could have caused this to happen. Next is gross margin. That's gross profit over sales revenue times 100. We compare the 2 years. In that question, the gross profit margin increased, which is a good indication. Then markup is gross profit to cost of sales times 100. Here, 2014 was 63, 2015 is 79. So that means it improved in 2015 over 2014. Profit margin is profit for the year after interest divided by revenue. From the formula, profit after interest is uh, the 46 and 20. Oh, no, no, no. Profit for the year, okay, that's 309 and 287. 309 and 287. That's profit for the year after interest. Okay, we have I'm sorry, I'm looking for what was done here. Okay, this profit 454, profit before tax, and which is after interest. Finance cost is the interest. Then 438. Sorry for a little delay there. Divided by revenue times 100. For 2015 is more than 2014. Sorry, 2015 is 17, 2014 is 21. So something is going on wrong here. It is not a good indication to have this to be reducing. Expense to revenue ratio. We look at the proportion of expense to revenue. 2014 is 17.1, 2015 is 26.7. You would like that expense to revenue should be reducing, but in this case, it is actually increasing. That may affect the eventual profit retention one way or the other. Then now to liquidity ratios, we look at the ability of the firm to pay short-term debt or to turn assets into cash. Liquidity ratio assesses the ability to pay short-term liabilities as they fall due. This includes trade payables and salaries. This doesn't really concern long-term investors as they are interested in solvency. So liquidity ratio is ability to quickly pay short-term debts, ability to pay short-term debts rather. Now, current ratio and asset test ratio are common ratios that we consider in liquidity ratio. For current ratio, it is current asset over current liabilities. When we go back to the question, current asset here is 500 and current asset here is 900. Current liabilities is 314 here and 305 here. So current asset over current liabilities for the 2 years is what to compare. And in this case, it's 2.59 ratio 1 in 14, which is not so good. It 1.21 ratio 1 is good. It means here that your assets are idle. It shows there is overcapitalization. Your assets are idle. You are under trading here in 2014. But in 2015, it shows that you are making better use of your assets or of your current assets. Then asset test ratio, or sorry, current ratio here, I'm so sorry. Current ratio is 2.95 here to 1.59. So that means you are not doing well here. There is overcapitalization or tying down of assets here. In 2015 is fair because 1.5 ratio 1 to 1.99 ratio 1 is considered fair enough for many businesses. But anything that is two and more than 2:1 is already tying down uh, unnecessarily your assets. This one too, the average should be usually 1:1 to 1.49:1. So anything that is more than that is usually considered bad. So in 2014 it's not so good, 2015 is fair, is better. So for efficiency ratios, we look at the non-current asset turnovers, trade receivables turnover, trade payables turnover, inventory turnover, and rate of inventory turnover. Non-current asset turnover is net revenue over total carrying amount or book value of non-current assets. For trade receivables turnover, that's trade receivables over credit sales times 365 days or times 12 months. Trade payables turnover, trade payables over credit sales times 365 days or times 12 months. Inventory turnover is average inventories held over cost of sales times 365 days or times 12 months. Rate of inventory turnover is cost of sales divided by average inventory held during the year. Here in this example, it's 12.2 times. Here is 12.61 times. So which one is doing better? Cost of sales, we're saying rate of inventory turnover, you want it to be more. So the higher the rate of inventory turnover, the better, the more the ability you are turning your inventories to sales. So it's better in 2015 marginally than in 2014. So now, okay, the final one is a gearing ratio. That's debt divided by your capital employed times 100. Your capital employed is your long-term debt and your equity. So addition of that is your capital employed. So the proportion of the debt to your capital employed is your gearing ratio. Often, and okay, once the answer is more than 50%, once your debt is more than 50% of your capital employed, the firm is highly geared. But the risk about this is that the prospective investors or prospective lenders may assume that the firm is being run on loans when a firm is highly geared. Now, finally, on this topic, there are limitations of this ratio analysis, and you may pause the video now and zoom up what we have here. They are a bit tiny, so but please avoid making assumptions where there is no evidence in the question. If you make assumptions, make this known that you have made an assumption. It is important that you do so so that you don't lose marks necessarily if you are preparing for exams or if you are practicing so that you don't shoot yourself at the foot. Please don't make assumptions if a case is not made known. Also, it doesn't consider to be most. Please pause and read this through as well. Thank you very much. And if you have time, please attempt this question. Attempt this question from the formulas given, gross profit margin. You comment on your results, expense to revenue ratio, the return on capital employed ratio. Please attempt this question and make your comment in the section in the under the video, and definitely I will respond to it. I give credit to Jasmine, who was helpful in making this PowerPoint. Then another resource that was used was Cambridge A Level as printed by Hodder Education. Thank you, my amazing viewers and subscribers. Make sure if you have not subscribed to subscribe to this channel and share the channel. You can share the information as well, but always ensure to make reference to this YouTube channel, Accounts and Business Made Easy. Thank you.